Friends, today we would be discussing on infrastructure financing. This first part, we will be discussing infrastructure financing. Before I start with this infrastructure financing, I would like to mention one thing. During the discussion on insolvency and bankruptcy code a few days before, so there I wanted to make an important announcement. In that unit number 33 of our module D, see, unit number 33, because some restructuring schemes were mentioned. As you know, RBI has been issuing guidelines. RBI has been guidelines for various restructuring schemes so as to revive the viable units. Those schemes are already there in the this one in the unit number 33. They are the new framework for revitalizing the stressed assets. One, RBI new framework. That is one. It was launched in 2014. Then corporate debt restructuring. That we call it as CDR. Then comes scheme for sustainable structuring of the stressed assets. That is properly known as S4A. Then strategic debt restructuring. That is SDR. Then flexible structuring of project loans. These five schemes or five restructuring schemes are already inbuilt in that courseware, which even though it was updated, subsequent to the updation, these schemes have been withdrawn or discontinued by RBI. Instead, RBI has introduced there is a scheme as a framework. It is known as a resolution of the stressed assets new framework. So those things are, that framework is not there in this one. But when you go through that unit number 33, please bear in mind that because these changes have taken place subsequent to updation, because that new framework has been introduced. This is the outcome of the enactment of the Insolvency and Bankruptcy Code. And insolvency IBC has been treated as the main tool for dealing with the debt default. As per this scheme, new framework, any debt above 2000 crore has to be referred to IBC or NCLT for resolution. And other things also. Below that individual banks have to formulate their corrective action plan, CAP, should be formulated based on that. This is about that which I could not while discussing on this IBC or infrastructure lending. I have forgotten to mention it. Now kindly take a note of it. Now coming to term loans, infrastructure lending. We are going to discuss a little bit on the infrastructure lending. Infrastructure projects, that involves some distinctive features. Like that we can say that the distinct features like exceptionally longer gestation period, exceptionally longer implementation period, long payback period, and above all, high debt equity ratio. These are these unique features, or we can say the distinctive features so far as infrastructure lending is concerned. So when we saw that any project, infrastructure project, if you go through that project, you will come to know that prior to this one, that incipient stage itself, in the beginning itself, there is getting these various clearances, various permissions, then land, acquiring the land, some dispute would be there. So all these things will involve in the gestation period. Now implementation period. Implementation also will take place. There also a lot of time lag is involved. Similarly, payback period, because these are all longer tenor loans, longer investment would be, the income generation would take longer periods. So the payback period will naturally be on the high side. or longer payback period. These are the and plus any infrastructure project if you take that always involve high debt equity ratio. These are the distinct features so far as infrastructure projects are concerned. Now, how or what is actually infrastructure lending? That infrastructure lending, we can say that credit facility. While doing this infrastructure, when we talk about the infrastructure, we say that the infrastructure financing or the appraisal of the infrastructure project are the same as that of normal project appraisal, because due to the assets liability mismatch involved in both the cases, and this will expose the lender, this will expose the banks to the credit risk. It's a liquidity risk, not credit risk, liquidity risk, because that's why the other projects as well infrastructure project, in both the cases, they are by and large they are the same. The basic principles are the same, but one principle the same on account of this liquidity on account of the liquidity mismatch, and that will lead to liquidity risk. Then what is a see any facility, credit facility, any facility granted or extended by the lender. Lender, when we say that lender or lenders, we can say that there is banks, then all India, select all India financial institutions, then refinancing companies, etc. They are coming under this financing of infrastructure project. So their exposure in the following, in the exposure in respect of certain categories, certain infrastructure subcategories are qualified for infrastructure lending or infrastructure financing. They are, there is credit facilities, we can say that the lenders in respect of transport, energy, water and sanitation, then communication, social and commercial infrastructure. These facilities, any exposure taken by the lenders I told you, that is banks, select all India financial institutions and in refinancing companies, wherever they are involved in infrastructure financing, their exposure in respect of these infrastructure sections or subgroups, that is transport, energy, water and sanitation, communication, and social and commercial infrastructure, qualify for being treated as a infrastructure financing. Then there are certain criteria. No, anybody can finance. No, there are certain criteria has to be fulfilled for undertaking this financing of the infrastructure. What are they? According to RBI, provides that any infrastructure unit which is technically feasible and financially viable and a bankable project can be financed by any lenders, that is banks. Now we talk about mainly on banks. We are the bankers. So any project which is technically feasible, I repeat, technically feasible, financially viable and bankable project can be financed, or banks can extend credit financing arrangements in respect of if it complies with these three things. And not only that, in addition to that, this unit will also lender should also comply with certain additional criteria, additional conditions, additional parameters. What are they? First and foremost one is that is compliance with the prudential exposure norms. When we talk about prudential exposure, which that the banks cannot lend to anyone beyond a particular limit or particular exposure limit. That is known as the prudential exposure limit. Here in the case of individual, I think in the earlier classes I mentioned this one, prudential exposure norms so far as individuals, so far as a group. But I repeat here, The individuals, it should not exceed 15% of the capital funds of the bank as of the previous 31st March of the previous year. That is individual 15%. But for infrastructure, further 5% can be considered. So we can say that 15 plus 5, making it 20%. And very extraordinary case, very exceptional case, the board can approve further 5% for other activities. So in all, when we say that what is the maximum exposure for an individual, individual can take, here individual unit can take, or individual unit, individual exposure, individual enterprise can take, that is 15 plus 5, that is 15 plus 20 plus 5, that is 25. 25 is the maximum. Exposure norm says 15. These are exceptional cases. 5% for infrastructure additionally is provided by RBI. Then the individual board can further give 5%, making the total exposure to 25%. That is within the permissible, provided the additional 5% should be duly approved by the board of directors of the respective bank. As regards this group also, it is 40. It should not exceed 40% of the capital funds. Their infrastructure additionally, banks can give 10%. So we can say that 40 plus 5, 40 plus 10, so making it 50. Then again, same way as that of the individual, 5% extra can be considered in exceptional cases by duly approved by the board of directors, board of the respective bank. Then maximum when we talk, that is 55%. That is 40 plus 10 plus 5, that is 55% of the capital fund. While talking about this, this one, capital exposure, here it is different. That is 40% of the network, whereas here it is exposure norms. It is always based on, that is capital funds. So individual 25 is the maximum, and the group, that is 55 is the maximum, including 10% for infrastructure. The infrastructure can be more than that one, but additionally that exposure 10% can be added. Now another area that is to be complied is, that is assignment of risk weighted for assets for credit risk calculation, CRAR. CRAR, what would be this one? That is based on the new framework, or the institution should comply with, that is maintain the risk weight as per the credit risk. Okay, the new framework. Then another one is, as I told you, there is a unique feature so far as the infrastructure lending is that asset liability management. Asset liability management, the bank should have proper system, proper department, we can say that, proper structure for controlling, for monitoring assets liability mismatches, assets liability management. Because all these loans, infrastructure loans, are long tenor loans, and this is asset liability management should be there, else that institution will be forced to or exposed to liquidity risk. To avoid that liquidity risk, to take care of the liquidity risk, every bank should have full-fledged asset liability management department or adequate infrastructure. Now, administrative arrangements. Administrative arrangement, there is any project, the timely and adequate sanction should be there, whether it is a single bank, a sole banking, or a multiple banking, or a consortium financing. In all these cases, that arrangement should be there. It should be sanction should be synchronized in such a way that it should be early sanction, timely sanction, we can say that. And not only that, and bank should provide adequate finance also. Another condition to be complied with is that requisite expertise for appraisal. And banks undertaking this infrastructure project should have adequate expertise, adequate personnel to carry out this technical feasibility, financial viability, and bankability, all the things to be ascertained by competent people who can do this assessment or the study. The bank should have such kind of department or such kind of infrastructure. Then only go ahead with the infrastructure lending. Many times we will come across that many cooperative banks are not undertaking any infrastructure lending. What is the reason? Mainly the reason being because they do not have the adequate infrastructure to carry out this, and therefore they do not have the expertise to carry out the appraisal of the infrastructure project. Not only that one, because of the longer tenor involved. That is the reason why the small banks or cooperative banks are not involved, not interested, or not undertaking any finance for infrastructure project. Then another area is infrastructure project. Normally banks give the term loans, and term loans to the public sector units should be public sector units. Term loans should always be given to the corporate sector. In the public sector units also, it should be for the corporate purpose, and also the term loan should corporates only. That means the corporate means when we talk about corporates, special purpose vehicle, that also coming under the corporate, because the special purpose vehicles which are registered under the Indian Companies Act, either it is 2013 or the earlier one, then they can be treated as a public sector units. So term loans can be considered public sector for corporate units only, corporate entities we can say, including the SPVs which are registered under the Companies Act. And another this subcategory would be term loans should not be considered for budgetary allocation. For budgetary allocation, there is no certainty. No quantum may be later on varying. Later on, sometimes this allocation may not be received also. So as against the budgetary allocation, the guidelines are there, or the conditions are there. No term loans to the infrastructure project should be considered against budgetary allocations. That is not only applicable for any other project also. This condition is there. RBI is very strict on this aspect. But there is a provision that if the term loan is considered to supplementing this budgetary allocation, in the sense that suppose a budgetary allocation is inadequate, in that case it can be supplemented, or any enhancement, additional facility required to take care of any shortfall. So in that case, it can be, term loan can be considered for supplementing the budgetary resources, provided the same is already envisaged or contemplated in the project design. Project design, everything is there. Then only this term loan can be considered for supplementing. Please remember that supplementing only. No budgetary allocation, term loan should be considered. Then comes, as I told you, SPVs are also coming under the public sector, but SPVs, as a private sector SPVs are also eligible if the SPV is registered under Companies Act, and as also it is engaged in the infrastructure, undertaking the infrastructure project, so it can be. Then types of financing: working capital finance. We can consider working capital finance. In that case, it should be linked to working capital margin available in the project cost of the project. Now comes term loans can be given. Term loans in the sense asset financing term loan. Then project loan also here, individual term loan. Project loans, when we say project loans, means any total project cost, if that is financed, including contingencies, preliminary, pre-operative expense, everything that is included, those things, that is known as a project loan. Term loan, when we say, we can say it as asset financing. And here it is term loan. Then subscription to the bonds, debentures, preference shares, equity shares, the project finance already packaged. This can also be termed as deemed finance. Then any other type of funding, by the lenders, that is qualifies for financing. Then another is takeout finance. Another another mode of dispensation is takeout finance. It is a mechanism designed to avoid the asset liability maturity mismatches. Because the infrastructure lending, that is a main problem. Asset liability mismatches or asset liability maturity mismatches. To take care of this one, takeout financing. The IDFC is very prominent, and now State Bank also started doing it. And IDFC, what is actually the mechanism says? It provides that at this entire outstanding of in the books of the lender, that is in the books of the bank, is being taken over by the IDFC or SBI. So there, what is actually after on a predetermined base, it is already fixed at the initial stage itself. At the time of financing, undertaking the infrastructure financing, it is fixed. After 5 years or 7 years, the takeout finance would be there. They will take out IDFC and now State Bank, we can say that, but on a predetermined base. But here the credit risk is taken by the IDFC or SBI, and they will also take care of entire this monitoring, liquidity mismatch, everything. So by taking this credit risk, they take care of the liquidity, then asset liability mismatches, and limited availability, the expertise. Subsequent also the technical and all expertise that IDFC and or SBI, and even IDFC and FCI, they have already formed a structure, applicable structure, which can be suited to different banks. Moreover, they have also come out with a common agreement which can be executed prior to going for this one takeout finance. Then credit support from IDFC. In addition to the takeout finance, please bear in mind that entire credit risk, everything is taken care by IDFC or SBI. But in addition to that credit support, liquidity support from IDBI is there. This is sort of an alternative to takeout finance. We can say that it's a refinance arrangement. Refinancing the entire outstanding after an agreed period. That also here, whether it is sometimes 5%, 5 years or 7 years. In this case, the credit risk is taken, should be taken by the respective bank, and the risk is monitoring, everything should be by the respective bank. Here it is only a refinancing, not unless in the case of the takeout finance, entire thing is taken over, including outstanding. Here it is refinancing entire thing at a there also predetermined base, and the rate of interest, everything would be charged, since there the risk is taken by the IDFC on the bank rather than the borrower, borrower. So based on the risk perception on the bank, IDFC will fix the rate of interest. That is what the additional, that is credit facility by IDFC. It's an alternative to this one. Then another one is, we can say that interinstitutional guarantees. Banks can issue guarantees in favor of other banks. Suppose the one bank doesn't want to increase more this one, they can issue guarantees. They can issue guarantees in favor of other banks, and based on the guarantees issued by the bank, other bank will finance. But there is one condition. The condition is that the issuing bank should have at least taken at least 5% of the 5% funded exposure in the project cost. That should be there. Then only that guarantees can be issued by the issuing bank. Then not only that, they should undertake their normal credit appraisal, then monitoring and follow-up of the project. Another mode is that financing promoted equity. Banks are not permitted for promoting, but in the case of infrastructure lending, exceptional cases for shares of the existing company engaged in implementing or operating of the infrastructure project, that is permitted for infrastructure lending, very exceptional cases. Okay. Then one more of these things, banks are also permitted to issue long-term bonds. That is a minimum maturity of 7 years for infrastructure lending to raise the resource. There it is permitted. That is not only for this one. Not only for this infrastructure, it can be for affordable housing also. Affordable housing, perhaps you must have heard that it is coming under the priority sector lending. But here for infrastructure lending, minimum the maturity period would be 7 years so far as the long-term bonds being issued by the banks for raising the infrastructure, and that is for affordable. The two things are there. These are the mode of dispensation, mode of this financing of the infrastructure. We have seen working capital, term loans, project loans, then takeout finance, and credit facilities by the IDFC, additional credit facility by IDFC. That's a refinancing. Then issuance of the guarantees by the one of the banks, issued by guarantees by banks in favor of other banks for undertaking this finance. Then promoters stake, financing the promoters in contribution. Then last one, issue of the long-term bonds by banks